I would like to officially welcome everyone to this evening's webinar. Thank you so much for your time and for attending. We are really honored this evening to have a number of fantastic people here with us. We have, of course, my co-host this evening, Christian Szpilfogel in Ottawa. Christian is an active investor and a mentor and a coach, and he specializes in commercial and sort of land development and all that big, sexy, fun stuff that most of us as investors are intending to get there eventually. We are also really fortunate to have Milena, who is a lawyer in Cornwall, and she's going to talk to us a little bit about sort of from the legal perspective what we need to cover this evening. We've got Sue, who's a mortgage broker in Ottawa with Platinum Mortgages. Fantastic job there. And then we have Alex, who is an insurance broker out of Ancaster, Ontario, and he's able to help clients across the country. And then we have Bob as well, who is an accountant, and he's based in Peterborough. So we have people from a range of different markets. Everyone here is an active investor themselves. They have properties and they are actively engaged in being part of the real estate community too, which is what I love. I see everybody at events and I think that's awesome. So give me 1 second here and I'm just going to share my screen with you. Oh, that's not where I wanted to go, but this is, there we go. All right, well. Apparently, it's going to be one of those webinars where things just don't go quite according to plan. All right, there we go. So there's myself and Christian. Thank you so much for joining us this evening. We're really happy you were able to be here with us. Our agenda for this evening, we're going to try and keep it short and sweet. Everybody's time is precious. We said an hour and a half for this webinar. When we started working on it and I started talking to the speakers, it quickly became evident that this is a huge topic. So we're going to do our best to sort of skim the surface, and then if we feel that it would be beneficial or everybody and the attendees would like to, then we can certainly think about hosting a second one perhaps where we can dig a little bit deeper. But there's been so many conversations recently for a whole bunch of different reasons about which is the best way to go about investing in real estate. So we really wanted to focus on that and answer some questions. So we'll start with the welcome and introductions. I'll just do a quick overview. You know, when we talk about investing in corporations, what are we actually talking about? What does that look like? And then we'll get right into the expert panel and have them weigh in on the topic themselves. So Milena will go first, then we'll have Sue, Bob, and Alex will round everything out. From there, we have some investor scenarios, which Christian's going to present a couple of scenarios, and then we'll have the panelists will have the opportunity to weigh in, and then we'll do a summary of our findings. That will also be Christian, who will be keeping, I'm sure, notes based on what everybody says, and we're going to try and drill it down to a definitive answer. And we're going to put Christian on the spot because I'm hoping it's not going to be the standard answer in real estate, which is it depends. Although somehow I suspect that might be what happens.
Thanks for making the job nice and hard, Elizabeth.
My pleasure. All right. So first up to speak with us this evening, we have Milena. And Milena is a lawyer who I've become familiar with, I guess, probably in the last 6 or 8 months. And one of the reasons why I really wanted Milena to join us this evening, I mean, aside from all of her credentials and her fantastic experience, I love the way she looks at real estate. And it's really, you know, it's not the stodgy old school lawyer view, like I've been a lawyer for 80 years and this is the way we've always done it. That's not the approach that Milena takes. She really cares about her clients and she loves to be creative and really focus on problem solving. So that was the reason why I asked Milena to join us this evening.
Thank you, Elizabeth.
You're welcome. And then we have Sue, who is another lady who is fantastic at her job. You know, she's very well known in the Ottawa area, and she's been a tremendous support for investors in the Ottawa community and the surrounding area as well. She also has an annual event that she hosts with Tony Miller, and she really knows her stuff and knows, you know, where to go and how to get the job done. And she has got a real focus on customer service, which we all know. There's plenty of people out there in the world of real estate who say, work with me, and the challenge is, can we even get a phone call back from them? So we try to bring experts who, when you call them and have questions for them, they will actually get back to you. The next in our lineup is going to be Bob. Some of you may be familiar with Bob already. We did a webinar with him a little while ago, but I love Bob because he's not just an accountant and a real estate investor. Bob is also an awesome guy who specializes in working with entrepreneurs. So he understands, the growing pains that we go through. He's not just an accountant who we're just another number. When we were struggling with the COVID subsidies and those kinds of things, I reached out to Bob and he was really generous with his time, very supportive, and really made it his mission to dig in and figure out how we as, small business owners and entrepreneurs can make the best of the supports and the things that are out there. So Bob's another one. He's got a somewhat unique approach in the world of accounting. He also dresses pretty well for an accountant. So, we don't get to see him tonight, but we're happy you're able to join us, Bob.
I was just going to say, Elizabeth, maybe that's why I don't want to be on camera. I'm not living up to your standards. Anyway, it's wonderful to be here, and thanks for having me, everyone.
My pleasure, our pleasure. And last but certainly not least is my friend Alex. And Alex has been my go-to guy for insurance for years and years and years. I just saw his dog Guinness. I love that. I didn't know your dog's name was Guinness. Alex has been with me since my days as a trainer for Rich Dad, where he helped me support students and ensure that, they had the right types of insurance, the right products with the right coverage. And there's definitely been a few times where Alex has been on the receiving end of one of my phone calls at 11 o'clock at night about a fire or a sewage backup or something like that. And I've never had issues with the coverage, so I'm very comfortable bringing Alex forward as an expert as well as an investor to be able to support the investment community. Thanks for joining us, Alex.
My pleasure.
Well, thank you. So we know that as real estate investors, we've really kind of struggled a bit with what should we be doing, what's the best way to go about this. And one of my favorite things, when I'm working with my coaching clients, I'll say, okay, well, let's look at asset protection. So they'll talk to a lawyer and the lawyer will say, you should incorporate. And then they say, great. And then I'll say, okay, let's talk about tax planning. So they talk to an accountant and the accountant goes, you shouldn't incorporate. And then they come back to me and they go, I don't know what I'm doing here. And then they talk to the mortgage broker and the mortgage broker goes, don't incorporate. I won't be able to get you financing. And it just turns into this whole thing where it feels really stressful for some of us as investors at times. And it feels really challenging. What do I do? What's the right way to do this? How do I protect myself, but still ensure that I can get the financing that I need in order to build my portfolio? So that's really what our focus is going to be tonight. I'm going to try and keep it sort of higher level, not super technical for those of you who aren't really familiar with the whole corporate structure and that kind of thing. And certainly, we're all available afterwards. At the end of the presentation, I will have contact information to provide for you. So if you have follow-up questions, you are more than welcome to reach out to anybody who is here. But what is really important right now is, so when we're talking about the corporate structure, just to be able to understand what it is we're actually talking about. So if we have ourselves as an investor, then we are going to be shareholders or owners in a holding company. This holding company is going to generate passive income. Underneath the holding company, we will potentially have two more companies. We'll have Active Co over here, which is going to generate active income, which of course is taxed at a much, much lower rate, which I'm sure Bob will touch on as well. And then we have our real estate holding company, which generates passive income. This is the company that actually holds the title for the properties when we're talking about a corporate structure. Whereas the active company, this is a company that we utilize to help us minimize our tax burden over here on the passive side, because our activities over here are taxed at a much lower rate. And for us as real estate investors, our active company might look like a number of different things depending on our investment strategy. So for some people, if you're going to do buy, rent, and hold, it might make sense to have a property management company. That would make sense. But, if we're flippers, why would we have a property management company? It makes a lot more sense to have a construction company. Or if we're doing rent to owns, maybe we want to have a consulting company. Or, if in the future we grow our portfolio, maybe we have a few different active companies, a few different real estate holding companies. And then we have the opportunity to look at different partnerships. So hopefully, Milena, I've sort of provided enough of a basic overview of when you're talking about corporate structure, what we're actually talking about. As investors, just having one company, I don't think provides the level of protection that we're looking for. So generally, we're looking for sort of this 3-company structure. So I will turn it over to Milena and let her talk about her I know it's always challenging to go first. I'm sorry about that. But hopefully I've teed you up enough and provided enough information for everyone. And I will now go over and monitor the chat and just make sure that if we have any questions, I'll be sure to jump in and let you guys know.
Great. All right. Well, thank you, Elizabeth. Thank you for inviting me here today. I'm very happy to be here. I've been a lawyer for nearly 10 years now, and over the years I've worked with many investors and I've faced the question of whether they should invest through a corporation or a corporate setup like you just presented many times. The answer is very gray, unfortunately. Investing through a corporation can work for you or against you. I've met people who should have incorporated and didn't, and some who incorporated and regretted it. I don't know if you want me to touch on bare trusts right away or if it's something you want to talk about after. You want to perhaps just let me know if you want me to address that now, Elizabeth, or?
If you can sort of explain how bare trusts would fit in, in 2 minutes or less, then yeah, absolutely, that would be great. Because I think then I know that's one of the workarounds that gets talked about a lot for us as investors. And so I think it's important that we definitely do sort of touch on it this evening.
Okay. Well,
if I may add, I think it would also be good for you to speak to why people should incorporate, right? So what are the attributes that they should look
for sure, for sure. So I just wanted to mention that there is this other option, which seems to address some of the concerns of either solution, which is holding the property in a personal name and using a bare trust agreement to assign the beneficial interest to the corporation. That's the gist of a bare trust, is basically you have one person or entity holding title to the property, but the person holding the title is only the trustee, meaning that they don't actually own the property. The ownership and the beneficial interest of the property is then owned by the other entity. So you have a bare trust between two people. You can have a bare trust where the corporation owns the property and the individual is the beneficial owner, or you can have the reverse where an individual holds ownership of the property on title and the bare trust agreement is set to give beneficial ownership to the corporation. So in theory, if we do it this way, the corporation would be responsible for all the costs, carry all the liability, and receive all the benefits from the property. However, there are some questions in my mind as to risks, for both in terms of liability and in terms of taxes, and actually about insurance as well. So I'll try to address as many of the different aspects that are affected whether ownership is held in a personal name rather than a corporate name or within a corporate structure tonight, despite the limited time. So the first item is that when a client tells me that they want to go in with a partner, they want to start like a business with a friend, or they have one particular property that they want to buy with a partner, immediately I think corporation. I think that is one of the no-brainer answers for me, because it is so difficult to create an agreement, a partnership agreement, when two individuals own a property that addresses all of the issues and that gives the same protections as a corporation, especially in the case of a disagreement. In order to dissolve the partnership is very difficult. So therefore, for me, that one is one where the answer is a little less gray. Then of course, it's the matter of mortgages, and I'll let Sue touch on that. It's more complicated and more expensive to have mortgages if you're holding a property through the corporate name rather than a personal name. The setup cost is much higher in a corporation. We're talking, I want to say, about $2,000 to set up a corporation. So in the corporate setup that we were looking at before, you're looking more like $6,000, plus the cost of shareholder agreements, rollovers if that's the case, if that's needed. And then if we're talking about the setup with a bare trust agreement, then we're talking higher setup costs. So there's definitely a big cost analysis to do in every individual situation to determine if the benefits offset all of these additional costs. And then there's maintenance costs because you have to maintain the corporations. If you're holding it in a corporation, there's maintenance costs every year that also have to be reviewed to see if those are beneficial or if the benefits offset these costs as well. In terms of liability, of course, holding properties through a corporation will protect yourself from liability in your personal name or in your personal assets. And, one thing that comes up often is, yeah, but I'm getting insurance, right? But insurance won't necessarily cover the liability that you can be incurring as a property owner when you're either renting or even if you have a rent to own or if you're the owner of a property. And so there's definitely more liability protection in the corporation. In terms of the landlord-tenant board, though, a corporation may face higher fines. I've noted that some of my clients will face higher fines than if they hold a property in their personal name, because the landlord-tenant board seems to think that because you have a corporation, then you're a big shot landlord who should know better. So that's something that I've seen before. Yeah. And then in terms of one other big item for me is estate planning, succession planning, family planning, it all kind of under the same umbrella. If you own a property or if you own your properties, especially if you have a park of properties and you own them all in your personal name, there's not much flexibility there. There's not much flexibility in transferring the ownership of those properties to your successors. It's more costly, it's more difficult, it's subject to probate. So if you pass away, it would be subject to probate to pass on to your successors. There are some exceptions, of course, always. If you own it as joint tenant with someone else, then that would be one way that you could avoid probate. But the idea is that if you hold all of your corporations, all of your properties in a corporation, then you can draft a secondary will and pass on those properties tax-free. I feel like I'm skimming over some pretty complex topics here, but the gist of it is that in terms of probate, it is so much easier to transfer the shares of a corporation, and you do that probate tax-free, not income tax-free. I will let Bob address that, but you can avoid some costs to transfer those properties to the successor because the property actually doesn't change hands, the shares of the corporations do, and that's easier. And then also for especially reconstituted families as well. I know my husband and I, we choose to own our properties through a corporation because we each have children and we're second relationship, both of us. And so we made that decision because it's easier for us to plan the long term for our family. So it does provide a little more flexibility in terms of estate planning, succession planning, family planning. Another one that has come up for me, especially in the last few years, is disclosure. So in January of 2018, the government started requiring that every transfer of property be subject to disclosing some information to the government, including if there are any other if there's any other person or entity that is gaining a beneficial interest from the property at the time of the transfer. And so we are disclosing that. So there could be, I suspect, some insurance implications, tax implications, land transfer tax implications potentially to the corporation. Oh, sorry, I should have started with that. I'm talking about the bare trust now. If you hold a property in your personal name, disclosure is not an issue because it's clear that you own the property in your personal name. You're disclosing you own the property in your personal name. There's no issue there. If you own the property in your corporation, same thing. You're going to disclose that, and that's simple. But if we're doing a bare trust situation before, the only thing that would determine who is the actual beneficial owner of this of the property would be what you declare in your tax returns, but it wouldn't be disclosed at large, whereas now it has to be. The other factor is the identity of the owner. So if it's in a personal name, the identity of the owner is very easy to determine. If it's under a numbered company in particular, I found like that's a strategy that some people will use to, it really doesn't hide assets. If someone really wants to find out, they will find out, but it's not quite as easy to determine who the person is behind the corporation. Or if someone does a search of your name at the land registry office, for instance, in the case of a civil case or something like that, they will easily find all the properties under your personal name. But if they're under your corporate name, then there is an extra step to get there. And lastly, and probably the biggest ticket item on my list is taxes, but I will let Bob explain the differences there. So one question that I'm asking myself also is there a possibility of purchasing a property in your own personal name, proceeding with the purchase, and then after the closing, deciding to give beneficial ownership of the property to the corporation and doing a bare trust agreement at that point? So I know I'm taking it one step further here, and I'm wondering what the insurance, tax, mortgage, land transfer tax implications would be on all of that, if that was even a possibility. And so my conclusion, unfortunately, is that each situation has to be analyzed individually. Each is a complex puzzle to solve, a multifaceted problem, and it requires the collaboration of a team of experts to determine in each particular set of circumstances what is the very best setup. So that's what we do here. We collaborate with all the experts to make sure to have the best outcome for each individual situation.
Awesome. Thank you. So Milena, there were a couple of questions for you, which I think might be pertinent for us to cover just briefly if we can before we move on to Sue. So what was he? Oh, Mark said, oops, where did we go here? Sorry, there's more questions coming in. Mark said, what would be the point of having a corporation owning the mortgage and having the liability personally? I understand a bare trust, but it's the first time I hear the opposite.
I've seen it used in cases where the individual wants to not disclose who is the beneficial owner of the property. So that's where it becomes more difficult now with the disclosure. So they'll incorporate a holding company that's a numbered company, name a director to that company that is not the actual beneficial owner of the property, and then they'll do a bare trust where the director of the company, usually the lawyer, will hold and will manage the corporation, but the individual is the beneficial owner of the asset.
Oh, interesting. So it's a bit of a, okay. All right, that's really interesting. Okay, so Kristen said, did I hear it's better to have two wills if you have properties in a corporation?
1000%. A secondary will is so easy to do. In my office, just to give you an example, I charge $200 for a secondary will when I draft the primary will. So it's an extra $200 and it saves thousands in probate and legal fees and whatever at the time of death. It's a no-brainer. You absolutely need to have a secondary will the second you own shares in a corporation, because you can transfer those shares like probate free.
Awesome. Okay, great. Thank you. And last one, Kevin said, at what point is it too late to set up a bare trust? If I already own a place but want to set up a bare trust for tax benefits, is there a point where it's too late?
I think that's a question for Bob. I don't think I would have an issue doing that. I think on my end, as far as putting the paperwork together, I think I can assign that at any time, but I think there would be some tax repercussions, because I think in effect, you would be rolling over the property into the corporation, at least the beneficial ownership of so there could be some repercussions there.
Capital gain taxes, that kind of stuff. Yeah.
Do you want me to jump in and add my 2 cents at this point? Or do you want me to hold on to that?
Can we put a pin in that, and we'll come to you and you can answer it at that point, Bob?
Absolutely.
All right, thank you. Okay. Thank you so much, Milena. That definitely helped sort of clarify things. And the short answer from Milena was, it depends on your personal circumstances. All right, and we're over to Sue. Sue, tell us from a mortgage broker's perspective, what is the best way for us to buy and why?
So I'm probably the anomaly on the mortgage broker side, where I am a proponent of purchasing incorporations. And you mentioned at the beginning that the mortgage brokers say, oh no, don't do it. It's only because it's harder. And that's the honest truth. It's harder to get financing. It's a different structure. It's more complex document-wise. But that doesn't mean it's not better for you to start off your portfolio this way. So I've run into several clients who, you know, they've started their portfolio in their personal name, gotten to 5th, 6th, 7th, 10th property, whatever it is, and then they definitely regret not structuring it properly from the get-go. So I've run into that. I can't tell you how many times. I haven't run into too many people who have started the corporate structure, as you mentioned at the beginning, and have come back and said, I regret it. It just doesn't happen because there's so many benefits to setting up the structure this way. And I know that like on the accounting side, there's a ton of benefits, but I'm going to leave it to Bob. But what I usually do when I'm having that preliminary discussion with, let's say, a new investor, is I ask them what their plan is. Like, are you getting into this to maybe just have 1 or 2 rentals for a little bit of extra, or is this a business? If you are getting into it as a business, then by all means, you need to start off the right way with incorporating and with that proper structure, in my opinion. And so you can also start off small with the first 2-3 properties in your personal name and then decide that I love this. This is going to be my full-time gig. I'm going to build a huge portfolio and then move over to the corporate structure in that sense as well. I see that happen very often where someone gets their feet wet with their first, you know, up to 5 or 6 in your personal name is usually that point when you're getting a little bit maxed out on that end of it. And then you start the corporate structure and you jump into like a whole different realm of financing options. It's a different ballgame completely. So to a certain extent, yeah, it definitely depends on the individual and what they're planning on doing. But diving deep into the discussion from the get-go is super important, like having the consultation with the broker, with the lawyer, with the insurance companies, with the accountant. I always find that people might get one perspective and then make their decision based on the one perspective, which is wrong. You definitely need to take every single perspective, map it out, and then make the proper decision, because I've had people try to switch over from the personal to the corp, and it's painful for them. It's painful on the financing side. It's painful on the tax side. It's painful on so many fronts. So that's my best, I think, advice. And I am a proponent for it just because I see so many benefits. The other thing that people should consider upfront is that if you're already a high income earner, so, you know, you own a business and you have a really high income coming from the business, or you're employed and making a significant salary, adding a bunch of rentals in your name is probably going to not be fun at tax time. So that's another discussion I have with people, that, you know, you're already in this really high tax bracket. If you're buying solid rentals that are profitable, you're just increasing your tax bracket. So it's another consideration to take when they're thinking about incorporating or not. And so I don't know if there's any questions coming in, but I can also touch a little bit on what I've seen of the Bare Trust side. It's just starting to come up more often right now. And I just had a client who purchased the property in their personal name. The mortgage is in their personal name. And then it appears as though they registered the Bare Trust after the fact for tax purposes. And so we are doing new financing for this individual. And the reason it came up is because when we collected the T1s, there was no rental income being claimed on the T1s. So we asked the question, where's the rental income? Where are you filtering this income through? And then that's when he gave us all the information of the Bare Trust. So it definitely adds a layer of complication, I would say, that we have to now present this trust agreement and the documentation showing where the rental income is going. It will, not every lender will necessarily be okay with it.
So would there be a situation where a lender would decide not to renew or would decide not to refinance because this Bare Trust agreement was done?
Gotcha. I'm just on my Zoom call right now. That's what I see.
So on the renewal side, I would say if you're with a lender who is not asking for documentation, then you're renewing, you're signing a renewal agreement without any credit check or income verification. I don't think it would be brought up. it's going to come up when you're looking at refinancing or tapping into the equity of the property. Could they say no? I always tell my clients, at any point in time, a lender can change what they say yes or no to. So there's no way for us to give a solid answer that they will or will not do it. I think the Bear Trust is becoming more popular. And as the lenders start to see it come up more and more, they're going to start fine-tuning their guidelines and deciding what they will or will not accept.
Yeah, because it looks to me like most of the time when we're using Bear Trust as investors, we're utilizing it to get around the lender's restrictions.
Correct.
That's the #1 reason for it. So, I mean, it doesn't matter as much from a taxation perspective or from a legal perspective, but it has a tremendous impact from a financing perspective.
And this is where it could become, get on their radar, where they decide that if a loophole is being created, that's when they usually start tightening up their restrictions, right?
Yeah, absolutely. So a couple of things, Sue. So Milena added, she said, transferring properties from personal name to corporation incurs additional legal fees and land transfer tax has to be paid again, for sure. So, sorry, Kevin has a question here. Is there a cutoff income salary before you recommend using a corp to handle your single rental income? That would probably be a Bob question. Mm-hmm. What's an overview difference in process to get a loan? Okay, as a corporation versus an individual. That's definitely for you. And I think, Sue, you've highlighted one of the benefits of choosing the right people for our power team, because you came out right from the beginning and said, buying corporations, I can help you do that. Because the response from 95% of mortgage brokers is, don't buy in corporations because it's really hard for me to get you financing. Right there, Sue, you get an A+. Love that.
I always say it's not about me. It's not what is easier or harder for me. It's about what's better for the client. So I can have super easy deals and super hard deals. We do both. It's there's no picking and choosing, in my opinion. But the difference in the process to get a loan for a corp or an individual is definitely the number of lenders, like, first off, that are available. So, they're not, and I've had this discussion with so many of our lenders, why won't you open up your rental product to a corporation? Like, there is a need for it. There's a demand for it. And I've gone back numerous times and I tell them, like, I try to advocate for investors and ask them to start this. And lots of them have said that they've considered it, they've thought about it, but they don't want to get into that because I think one of their concerns is they're going to attract too many of those, professional investors. And you get to a point where lenders, when you start building a massive portfolio, a lot of them they want to have their clients that have 5 or 6, minimal liability and minimal exposure, and they feel safer. So the #1 issue is definitely options. We have less options on the corporate side. If you're doing a corporation, doesn't mean there's no options, it's just less options. The other thing that we see is, obviously, the interest rates are not the same. So generally, the interest rates being offered for individuals buying in their personal name is lower than the interest rates being offered if you're buying in your corporate name. And I'm kind of simplifying this to just the residential rentals that are maybe 4 units and below. If we look at multi-unit financing with 5 and up, whole different spectrum, where you're in a corp, you're getting amazing rates. It's very, very competitive. So if we stick to just the 4 units and below, the rates are bonused. But when I have borrowers come back and they, kind of worry about the increase in rate or how the rate is a little bit higher, I try to get them to look at the big picture. I mean, look at the tax implications, the liability, what happens later on with the, succession plan when you want to give the properties in the corp to your children, for example. There's so many layers to consider, where it's not about a 0.25% rate today. It's kind of like the long-term benefits, the long-term savings. And once someone understands that, then they start, in my opinion, leaning closer and closer towards that corporation structure.
Perfect. Thank you. Christian, would you like to take over and weigh in with your 2 cents, or perhaps shift over to Alex, to Bob, whatever works for you. Thank you, Sue. That was awesome.
Thank you.
Yeah, thanks, Sue. And I think we got some good perspective there, both from Sue and from Milena, in terms of some of the puts and takes associated with this, right? And you know, I think there was a question in here. You were talking a little bit about the land transfer tax if you tried to move things over to a corporation. And one of the mechanisms that might be useful there, and perhaps this ties into Bob later on, is the use of a bearer trust in order to be able to take something that you've acquired in your personal name, right, and move it in without necessarily triggering a land transfer tax scenario. So now, one of the reasons that we brought, you know, Alex in as well, right, and Sue, is because often when we get into these discussions, we think about lawyer versus accountant perspective in setting up the structure. And they are certainly key members of the team, but there are alternative ways of potentially protecting yourself and offering liability protection. So one of those, of course, is insurance. And so, you know, as a potential alternative or as a complement to a corporate structure, I thought that Alex could weigh in and give a perspective in terms of what could reasonably be covered without a corporate structure and what would be the additional advantages associated with it. So Alex, you know, I kind of give you a bit of intro there, but you've got free license to take it where you need to go. You're muted, sir.
Hello, can you hear me now?
Yep, perfect.
All right, good stuff. Yeah, thanks, Christian. So when it comes to insurance, there's really two areas or concerns that you should have. And the first is the financial or or separating your personal assets scenario. And the second is the underwriting and claims scenario with respect to corporations. The main takeaway is, and I see this common when I start working with newer investors, is you need to treat this like a business, right? And setting up the insurance for your portfolio, just like Sue has mentioned, is you want to establish something initially, right? So a common mistake that a lot of investors make is they'll call me and they'll say, hey, well, I bought my first property and I insured it with the company that does my personal house insurance. That's a mistake. You don't want to do that because you want to separate your personal assets from any of your personal lines insurance. So that's the first thing you want to make. Now, if you're going to insure it as a corporation initially, that's a good thing. What it will do, obviously, again, is protecting the personal assets at arm's length, sorry. But then you're creating that additional layer of protection. You know, it's hard in the event of a claim. It's hard to to pierce the corporate veil. So what I would recommend now, conversely, saying is some insurance carriers out there will not insure portfolios under a corporation. As most investors have probably found, the appetite for this class of business is very limited. There's only a small handful of carriers in the Canadian marketplace that will insure investment properties to begin with. And when you drill down or dovetail even further on that, some of the insurance companies like the Desjardins or the TD Insurance, they have such a limited appetite and they don't understand the corporation, right? So you have to find or work with a broker that has access to insurance companies that will insure your portfolio under a corporation. So that's again, you have to find the right carrier or person to work with respect to that. The other piece on that is I've had a lot of clients reach out to me and they'll say, well, Alex, I want you to go out in the marketplace and try and find me new insurance. And I did have a claim, but it was under my corporation's name, so I do not have to disclose that. That's a fallacy. That is not true. When you're filling out an insurance application, it's a contract, it's an application for an insurance contract. You can't misrepresent yourself. So one of the first questions on there is to do with your claim. So even if you have had a claim in a corporation's name, you must disclose that personally, right? So that's the second piece as well. You must disclose all that information when you are applying for new insurance. That's pretty much it. It's not as, it's very cut and dry. It's not that complex as opposed to the accounting or the legal assets or position. So that's pretty much it.
So Alex, so one of the things that that some people espouse, right, is they say, well, I don't really need a corporation to protect my liability because I can insure myself properly on an individual basis, and then, well, basically that aspect of it. So from your perspective, is that a fair assessment, or do you believe that there's additional protections associated with insuring within a corporation as opposed to within your personal name?
Yeah, so the answer, that's a great question, Christian. And the answer is not really, because if most insurance policies will have 2 million per aggregate, or sorry, 2 million per occurrence, 5 million aggregate is the standard limit within, or you should at least have that. Some insurance companies, when I review portfolios, they only have 1 million. So yes, there is, you have that protection, and any defense or lawsuit built into the liability portion of the policy. If you do set up your portfolio in a corporate name, you are creating that arm's length position. But let's say you have $2 million per occurrence and the judgment against you is $4 million, right? So the policy will only pay up to that $2 million limit for that claim. And then they can go after the corporation for, now and again, this would be a question for Milena, but then they could technically go after the assets in the corporation. Would that be correct, Milena?
Yes, that is correct.
Right. So the answer to the question is, Bob, some people think that they are 100% protected by putting the policy in the corporate's name, in the corporation's name, but that's not true.
Mm-hmm. And so if I read that right, it sounds to me too that you can probably get less expensive insurance policy by going with, say, a $2 million liability, whereas settlements associated with liability, I think these days are going from anywhere from 5 million to 7 million.
Yeah, exactly. So there is another solution out there. I want to keep this for tonight's tonight's presentation, but there is a solution that they're called an umbrella policy, and that is a very cost-effective way, especially if you have a large portfolio, of increasing your liability limit to properly protect those assets. So that's a more cost-effective way of doing it. But yes, you can, again, and what an umbrella is you buy a blanket $5 or $10 million umbrella policy. So it's one policy, and all the properties would come under that liability blanket. All right, as opposed to individually going into, some investors have 50 properties, some have 100, some have 150. So it's far more expensive to raise the limits in each individual policy, whereas you can buy one umbrella policy to cover all the properties in your portfolio.
Right. So if I kind of summarize what I think you were saying here is, you'll insure the individual assets, right? You can then put an umbrella policy above that in order to deal with any exceptional liability settlement situations.
Yeah.
And then the corporation acts as a firewall beyond that, so that the risk of losing all of your assets associated with something is largely limited to the corporation if it's structured properly.
Exactly. Yep, that's exactly it.
Okay. And Milena, I just want to make sure I didn't say anything wrong there. So is that an accurate statement?
Yes.
Okay. Perfect.
Maybe if I could just add, though, is that, if you have a corporation and all of your properties are in one corporation, of course, if there's liability that's incurred because of one building, all of the assets of the corporation are at risk, even though the assets outside of the corporation are protected. So just also something to keep in mind when you have different projects that you do differently and that incur different levels of liability, right? A flip doesn't incur the same level of liability as, a rental property.
Right. Exactly. And so the general advice that I think is given is that you have a certain amount of risk, if you will, that you're able to tolerate within a particular corporation before you create a new real estate holdco, right? To put additional properties. So,
Yep.
And that's why we have a master holdco on top. Okay, let me just take a quick look at some questions here so that we can, before we move on to Bob.
Luke had a good one for Alex Christian.
Okay, I see it. So the question from Luke is, how much would an umbrella insurance policy cost? Say $5 million coverage.
Yeah, so it all depends the number of properties that you have, right? So to give, as far as the pricing matrix on that, and again, that would be something that you would go out to, you know, there's 10 companies that come to mind that would want to compete for that business. It would be roughly per property, it'd be about $75 per property for the umbrella. So you just times that by the number of properties that you have.
So that sounds like a no-brainer in my perspective.
Yeah.
Right.
Again, it's a far greater cost-effective strategy as opposed to going into your individual portfolio and actually bumping up the limits.
Now, so this will come back to Sue then, right? Because Sue, as you know, there are certain lenders that say, well, I'm not satisfied with a $2 million liability. I want a $5 million liability per policy basis. But in your experience, if we say, well, okay, I'll do a $2 million on the property, but hey, look, I've got this umbrella that covers it as well, right? Do you find that lenders will typically accept that or no?
I think in general, they have accepted it, but what we've seen in the last few months is our lenders being much more finicky regarding insurance. So there's been a lot of back and forth between the funding departments and the insurance brokers. And I'm sure Alex can attest to this, where it's like the fine details all of a sudden have to be exactly what they're asking for. So, and I think it's going to continue to change. It's kind of like an ever-changing landscape right now.
Yeah, my favorite is they bring in insurance consultants on the lender side now, which I don't think.
Risk managers. I absolutely love working with risk managers. It's a lot of fun. and it does nothing but increase the premium for my client. There's no protection afforded to the client at all. It's the lender that brings it in. So I'll get a documentation of the insurance requirements that are listed for this deal, and some of the things on there are absolutely ridiculous.
Absolutely. So this is part of why I was asking Sue on that in that respect, because this is one of those hidden costs, especially when you're doing some of the larger commercial stuff. So,
correct.
So we've got a little bit of extra time, but I think what will probably make sense is to move forward with Bob, unless I've missed an important question here. Let's see.
There's a whole bunch of questions.
Okay. So let's do those questions. That's fine. I just know that sometimes when we get into the accounting side of it, it's a rather, there's a lot of stuff there. All right. So Tim Tsai, welcome Tim. Haven't talked with you for a bit, but he says, what if a corporation is set up specifically to lend via mortgages and PNs? Would the umbrella coverage still apply? Yes,
it would. Yeah.
Okay. Let's see. I think that was it. Did you see any other ones in there?
Yeah, there's one there from is it Millennia? Am I pronouncing that properly? Millennia? Milena. Sorry, my apologies. Yeah. So at what point? And that's a very common question. Milena, is at what or how many doors or actual dwellings do I have to have? I would say to make it cost effective. I've had some clients that, you know, on their 5th property, they'll actually bring in the umbrella solution. But from a pure cost savings, once you get around the 10th property, that's when you would say, well, that's when the umbrella saves you money, between 5 and 10.
I don't know if we answered Mark's question. So he had in there, when a corporation had a claim, you have to personally disclose it, question mark. Is this based on directorship or shareholder?
It would be both. So again, when you're applying for, now I don't know what it's, Sue can attest to that when you're applying for a mortgage, but when you're applying for insurance, there is a question on there, and everyone's had this, it doesn't matter, car insurance, whatever, they want to know the claims history. So if, again, and I've had some clients say to me, especially on large portfolios, right? They had unfortunately, they had a claim on one particular property, but it was in a corporation's name. And they said, well, I don't have to disclose that because it's not personally. It doesn't matter whether you're a directorship or a shareholder. If you've had a claim within that corporate structure on one of your properties, you have to disclose it.
Okay. All right, perfect. I think that is all the questions I had specifically for you, Alex, but we'll get into scenario testing shortly. And so Bob, you're up, sir. And one of the biggest pieces in setting all of this stuff up are tax implications. Things are typically cheaper when you're doing things in your personal name, as Milena was explaining. And there are certain tax advantages that come into it. So I think I'll let you kind of freewheel it a bit, Bob, on this, right? And then I'll probably have a few questions for you a little bit later. Bob? Okay, you're muted now, Bob. Okay. Yeah, we're not hearing you, Bob.
No, that sounds great. Thank you. Oh, no.
No, go ahead. We're hear you now.
You can hear me?
Yes.
Okay, sorry about that.
Yeah, Bob, I think your internet connection's weak.
Be dad and be accountant. Do you still hear me?
Yeah, I think your internet connection is a bit weak, so we're losing you every once in a while.
Okay, well, I'm gonna try from here if this works. As long as you can hear me, I'll give it a go. Unfortunately, my signal's not overly strong at the moment.
So far, so good.
So far, so good. Okay. Well, I definitely appreciate everybody teeing me up with all the questions. That's great, and it always falls back to the tax guy. So I can certainly appreciate that. But I guess the way I'll start off is talking about the different structures and how they're taxed. And I know that Elizabeth had a structure set up at the beginning that talked about the 3-tier structure. And I'm going to just maybe identify those as far as a real estate acquisition strategy. So in the initial piece, she had a real estate company that was set up that she had essentially indicated that's how you're going to go ahead and purchase all your real estate. And we want to essentially get those in a separate corporation for a bunch of different reasons. And I'll talk about maybe the difference between personally and corporately in a few minutes. But essentially, we want to make sure that those are set up in a separate corporation, one for liability. And I think, you know, when we just spoke about insurance, whenever there's an opportunity for insurance to not cover the liability, I think it's always good to use a corporate structure to make sure you've got that second layer of protection to make sure that you're protecting your personal assets. The second tier that Elizabeth had talked about was the management company or the active company. So the reason that we talk about setting up an active company is that the small business corporate tax rate, especially in Ontario, but across Canada, is extremely low. Ontario is 12.2% in 2020. So there's exceptional benefit related to making sure that our income comes in at a 12.2% tax rate versus the highest marginal tax rate being 55%. So there's exceptional benefit for tax purposes to set up this structure this way. And essentially the way that the active company works is that it charges management fees over to the real estate company, and we draw the income out of the real estate company and into an active company. Now there's other planning that we have to take into account, multiple sources of income and other, certain initiatives, but it's a planning opportunity for us to set it up appropriately and get access to that 12.2%. And the third tier that Elizabeth talked about was the holding company. Now, the reason we want the holding company in place, and I think maybe I saw a question or two come through identifying the use of a family trust in there. And it's possible that we might want to have a family trust set up in between the active company and the holding company. And the reason we would want to do that is just for pure flexibility. Now, when we take money from either the active company or the real estate company, and we want to flow all of it up. And when I say flow it up, I mean, let's pull out all of the cash and equity that's involved in those companies, at least as much as we can, and get them out and into a separate company. The reason we want to do that, again, should an issue arise where maybe in some, a fire or a death, insurance maybe doesn't cover it due to negligence, or the individual who created the policy didn't create enough insurance money that's there. We want to just make sure that any excess cash or equity is out of there. So when we take cash and we transfer it from those bottom tiers, the active company or the real estate company, and we issue a dividend, it either goes up to a trust or up to the holding company. When we do that, there's no tax on that flow of money. So again, we issue a dividend up to the holding company, whether it's through it, because the companies are considered connected. I'm not going to get into all the boring details of how that works, but just know that when you pull equity from the bottom up to the top, there's no tax implications on that. And then your holding company at the top really just accumulates your excess cash and any of the non-real estate investments. So that's kind of how that structure works. The reason I might introduce a family trust in there would be for pure flexibility. So if we wanted to have multiple beneficiaries, whether it's other family members or maybe close friends, parents, kids, whatever it is, we can have them as beneficiaries of a family trust, and we can pay out to them whatever amount that we as the trustee deem is appropriate. So we have pure flexibility over how much can be income split. So there's a huge opportunity there from a flexibility standpoint and an income splitting standpoint. Again, new rules related to income splitting that we have to watch out for, but it does provide us the opportunity for flexibility. One of the things that I think has been brought up a few times talks about the succession plan. So one of the great things about having a corporate structure is that a corporation is a separate legal entity outside of you. So if we were to hold real estate inside our real estate corporation and something were to happen to us as the controlling shareholder, the properties aren't deemed disposed of. So what happens if you own them individually? There's one rule that allows you to roll it to your spouse on a tax-free basis. But if you're the final remaining spouse in your family, if you own these properties personally, it's deemed disposed of, and your estate essentially has to pay capital gains tax on the disposition of all these properties. If you hold these inside a corporation instead, what happens is the shares that you own inside the corporation are deemed disposed of. Now, if we set up a family trust and the family trust owns those shares, if something happens to you, you put in your will how you want those shares to be allocated, or how the trust is going to be delivered essentially out of there, but there may be no tax, capital gains tax on any sort of transfer of those properties by using a family trust. So that could be an exciting tax savings from a succession planning standpoint. And I think, for the extra money, and I'm not sure, I know we've got other lawyers on the call, but from my understanding with lawyers that we work with, it's usually about $1,000 to set up a family trust in the middle. So like had been mentioned before, if you're going to get into this sort of real estate acquisition, and it is a long-term strategy for you to build equity and wealth in your life, for the extra $1,000, we should probably get it set up properly right out of the gates.
Mm-hmm.
And I was kind of making notes as we went through there on some of the different aspects of it. I guess maybe I'll touch on the Bear Trust and how that works. So, and I have a personal example as well that I just did this year, that, we wanted to go in, and it's so great to hear mortgage brokers wanting to structure mortgages through corporate structures. It's kind of refreshing because I know lots of us have had mortgage brokers say, we're not going to be able to do that because it is a lot of extra work. But what I did this year is I purchased a cottage that the intention is to have it rented out partially and partially for personal consumption. What we did is we actually created a bare trust agreement where, we went through and got all the financing in place with the bare trust agreement so that my holding company ended up being the beneficial owner of it. Now, one of the reasons we want a corporation to be the beneficial owner, and I wish I had a whiteboard that I could draw this out, but if you think of rental income, for example, let's say we make $100,000 in rental income and our tax rate personally above $200,000 is 55%. That leaves us with $45,000 after income tax to either reinvest in a new property or to use that money to pay down our mortgage. Now, if we use a corporate structure and we're able to get the taxable income down to a 12.2%, that leaves us with 88% or 87.8% of after-tax money to use to either invest in another property or to pay down our mortgage. So one of the downsides of having property personally is that personal tax rate on that rental income. If it is at the highest rate, it is at 55%, where we can, with some effective planning, try and get that real estate income down to 12.2%. So for example, back to my story of my example of buying the cottage, what I didn't want to do was take money out of my active company, pull it out personally, pay dividend tax on it to use that for a down payment for my property. So what we did is we made the bare trust agreement. We had my corporation, one of my holding companies, become the beneficial owner of this property. And now, because it's inside a corporation, I can use the pre-tax money or the after tax at 12.2% money to pay down my mortgage instead of paying 55% tax and then paying down my mortgage. So I'm going to accumulate wealth much quicker under that structure. Hopefully that made sense. I tried not to get into too many weeds, but I know it's pretty hard when we start talking about corporate structures.
So you did a great job there, Bob. And I think one of the other things perhaps to point out, so I love the fact that you brought up the retained earnings aspect, which is really about, taking advantage of the lower small business tax rate. Now, if an investor is typically taking out all of the earnings and going back into their personal name, then that gets wiped out, right?
Yeah, it's a good question. For those of you who may be real estate agents, in Ontario that real estate agents are just able to incorporate as of October 1st. So that's been a major project for us. So one of those situations is outlining the different tax opportunities for realtors to incorporate when predominantly they spend all of their money by the end of the year, whether it's on advertising or just on personal consumption. So we've actually gone through and, if you take into account CPP contributions that are required for self-employed individuals, you actually still put money in your pocket using a corporate structure. And it's around $3,800 that you put in your pocket every single year using a corporate structure, even if you take all of the dollars out of the corporation. Now, the one benefit though, is if you're using a corporate structure and you are investing in new real estate, which seems to be the message of this group, every dollar that you use from a corporate structure as a down payment for your next property, you're going to save about 43% tax on it. So instead of pulling it out personally, paying that complete 55%, we pay the 12.2. We have, the remaining money in there, and we're using that to invest in the next property, which saves us, defers us, but ultimately saves us in the short term, paying tax on that value.
Perfect. Now, a question that I think was raised by Luke is, let's do it. So the way that you're moving money from a real estate corporation into the active corporation is typically in the context of charging, say, a property management fee back onto the real estate corp. So the question then comes into HST implications. So there's the 12.2% as the tax rate, but you do have to, and correct me if I'm wrong, but I believe you have to charge the HST on that property management fee. Is that right?
If the property management fee is greater than $30,000 a year, you would be required to register and remit HST. Yes.
Right. And so that's if the earnings within the property management company are in excess of $30,000, or whether there's revenue in the overall corporate structure.
It would just be in that property management company. Otherwise, you would fall under the small supplier threshold and not be required to register for HST.
Perfect.
Now the other side too would be, and this is where, you know, HST starts to get a little bit complicated when dealing with real estate investments, is that on commercial properties, HST is typically applicable, right? So if you're renting to a commercial space, to a retail, or to a manufacturer, or to office space, typically, if your commercial activity is greater than 30,000, you're already collecting and remitting HST on your commercial rent. So when that's the case, you can actually charge the management fee on the commercial rent, and it won't cost you any extra HST, right? You would get the input tax credit on the commercial real estate side, and then you would remit it on the active business side.
Perfect. Great answer. Thank you. So now next question is, let's see, just make sure. Yep, I think there's one. At what point is it too late to set up a bear trust? If I already own a place but want to set up a bear trust for tax benefits, is there a point when it's too late?
So, and I did hear that question brought up earlier. So my answer somewhat is, it depends on if the lawyer is willing to backdate a trust agreement. And in many instances, I feel like they're willing to backdate a trust agreement because the trust agreement doesn't really go anywhere. It essentially goes in the file, maybe to the mortgage broker, as was mentioned earlier. But once the legal title is registered, maybe I'll answer it this way. Once the legal title is registered in one individual, like if it's in your name and you want to transfer that title into a corporate entity, it becomes a little bit challenging because there is land transfer tax that will apply on that transfer. Now, so that's one tax implication. The other would be if there's accumulated appreciation in the value of the real estate when it gets transferred as well. We can, under Section 85 rollover, again, trying not to get into the weeds, but there is a tax election that we can make that can transfer an asset from an individual to a corporation without triggering capital gains tax. And then you would have to eventually pay the tax if you sell the building. So there are options there to avoid the income tax side, but the land transfer tax on any sort of transfer in would be a bit of a challenge. So when it comes down to, you know, the tax side, what they're going to look at is, you know, what was actually in place at the time the rental income was starting to be incurred. And, you know, if we can justify that, you know, there was a corporation in place and that a trust agreement was in place and that the rental income was being deposited into the corporate bank account related to that rent, we can still substantiate it. The longer you go, the more complicated it gets. So in essence, I would always try and make sure that you have these things done in advance, because doing it after the fact gets a little bit complicated and a little bit nerve-wracking for those that are trying to help you get it planned out properly. And let's just do it right before it happens. Perfect.
Now, you talked about a family trust and presumably holding shares within the top-level holding corporation. There's a couple of questions around that. One is, you know, with a family trust, trusts, I believe, have a crystallization of what, every 25 years or so? So
21. Yeah.
21 years. Okay. So is that something to consider before setting up a family trust?
It is, for sure. One of the things that we can do inside a family trust is we can effectively, like I was just talking about that rollover, we can do a little bit of a reorganization every 21 years to roll the value of the trust and the assets held in the trust into a new trust. So we can avoid that, or avoid some of the tax on that deemed disposition after 21 years. So it is something definitely to consider. Like if you plan on having this for a longer period, or, you know, you want to leave it to your kids, it would just be something that we want to, again, have a conversation about to make sure that we understand what steps we need to take to avoid the tax implications.
And I presume then that you would recommend a family trust over, say, adding other people as shareholders within the holding corporation?
So what we normally would do, so again, without being able to draw a diagram, we would normally have that lower tier, which is the active business and the real estate purchase corporation at the bottom. We would have a family trust just on top of it that would own the shares of both of those two companies. And then we would have the holding company up above. So the holding company would actually be a beneficiary of the family trust. So that if we put any of the proceeds up, so we flow it up family trust, the family trust can flow that up to the holding company without any tax implications, for the same way that I was mentioning earlier. We would then have the holding company
Sounds like Stephen Hawking.
The family trust subscribe shares to the holding company, so it's like a big loop-de-loop.
Right. Okay.
If that makes.
We missed all the important bits in there.
Did I lose you?
Yeah.
Oh, sorry. Essentially, what I would do, hopefully you got the bottom part where the family trust is in there. We would then also have the holding company would be a beneficiary of the family trust, meaning that we could flow money from the bottom through the trust up to the holding company. And then we would actually have the shareholders of the holding company be the family trust as well. So it would be a whole loop-de-loop where we can continue to flow money around until the beneficiaries of the family trust, the individual beneficiaries of the family trust, pull money out. That's when tax implications would happen.
Perfect. So I've got a couple of questions here from the viewers. Let's see.
And I guess it was interesting because everyone ultimately came to the "it depends" situation.
Yeah.
And what I would say is, from the tax situation, it definitely depends on your individual circumstance what makes the most sense, right? If you're in a personal income tax bracket that's less than 12.2% and you're not worried about liability related to a property, then you probably own it in your personal and you own it personally. Whereas maybe if you're under 12.2%, but you want to make sure there's that extra level of protection because you have a high net worth, then you probably want to use a corporate structure. So it does completely depend. Your tax situation could be the same, but your liability protection concerns might be different. So the important part would be to talk to your advisor and make sure that you have a personalized plan that's made for you.
Perfect. Now, Kevin has a question. I'm not sure I completely understand it, but he says, if you use up all your money in the Corp, would you raise eyebrows in the CRA?
So it depends how you define using up all of your money. So if you, as a shareholder, pull every last dollar out. So for example, we have real estate corp that's in the bottom, accumulating our real estate, and we pull every single dollar of our retained earnings up into a holding company. There are new rules that have been put in place that say, yeah, maybe we don't want to do all of that, but we could likely take, 90% of it and pull it up into that situation. So does it cause concerns for CRA? Potentially. The one concern is safe income rules. So if anybody's interested, they can look that up. However, whether you own real estate personally or inside a corporation, there's always going to be that reasonable expectation of profit rule. So if you keep accumulating losses over and over and over again, they may start having concerns about it. But losses in real estate are really controllable by whether or not you take depreciation or don't take depreciation within a year, right? Because a lot of times when we create losses inside a corporation, a lot of it's dependent upon claiming depreciation on those assets. So even though there's some restrictions on depreciation and whether or not you can create a loss with depreciation, if there's no money being made in there, a lot of times it's because we've depreciated the income down to zero.
Perfect. Thanks. Okay, so we're going to move forward. The next piece of it is really to just talk about, we'll see if we can put one or two scenarios together and where others can chime in. So I think what I'll start with is probably one of the corner cases, because that always generates a little lively debate. So investors come in all kinds of shapes and sizes, right? Some are just want to have a little bit of a nest egg for their retirement. In other cases, right, they're wanting to build an empire, right? So, and of course, there's everything in between. So the first question I would put forward to you guys, right, and to get your perspective as professionals, is, I'll just read out my question, right? I think you've seen it. I plan to invest in buy, rent, and holds, say single family homes or duplexes. I only want enough to have a good retirement income. And I think, 5 or 6 mortgage-free properties will meet my needs. So if we talk about it purely in the context of whether or not to incorporate, I have a funny feeling Milena will probably say you should incorporate all the time, right? But if we have an open discussion about that, I'm putting words in your mouth, Milena. So what would be your perspectives, taking it from each individual's perspective? And Milena, why don't we start with you since I put you on the spot?
Well, the first thing I would do is I would ask the individual who's their circle, who's their network. So, who's your accountant? Do you have a coach? Do you have a mortgage broker? And then I would contact these people and try to have a little powwow and see what each person brings to the table. So that would be like my first, and that's going to be my answer to start with every single one of these scenarios. But my gut says that in the first case that you're talking about, sorry, just one question. Are they talking about wanting rental income when they retire, or are they talking about wanting rental income to supplement their income now?
It's primarily for when they retire. So they probably have a job. They're picking up some assets in order to provide for their retirement, presumably because they don't have a pension plan, right? So this is the way they're planning to supplement their income, perhaps in conjunction with an RSP.
Depending on the profitability of their projects, I would say yes, incorporate, because even 5 or 6 properties, if they're mortgage free, they should generate good income if they choose them right.
Okay. I was hoping Bob could chime in on this one, but I think he lost his connection completely. Alex or Sue, would you like to add any comment?
I would probably say along the same lines as Milena, if you're going to have 5 or 6 properties completely mortgage free, you should be making really good income on those, and having them in the lower tax bracket and being able to control what you draw personally versus having it all in your personal. That would be the deciding factor for me. I would say strategically planning, it would be better to be in a corporation.
Right. Alex, did you have any comments?
Yeah, you know what? It doesn't really matter from the insurance perspective. The only thing I would say is, again, is just make sure that you are getting separate commercial wording policies. Don't insure it as an extension of your house policy, but it's really no big difference.
All right, perfect. Okay, so let's go down a totally different scenario, and some of these kind of come back to taxation, but instead of the buy, rent, and hold aspect of stuff, if we take a look at some of the active income strategies, let's say I want to be the wholesale king, or I want to be the RTO queen, and I will add some passive income assets over time. Would that change the way that you actually structure the corporations? Would you still go with that basic 3-tier model, or would you do something different? So Milena, why don't we start with you?
So large amounts of rent to own?
Yeah, so you're going to be the wholesale king or the RTO queen, right? So you're going to be doing lots of volume.
Yes, whole corporate structure, for sure.
Yeah. So that one, from a taxation perspective, is clearly beneficial because it's a highly active business. Mm-hmm. And in that particular scenario, there's clear tax benefits associated with it.
Well, I would step on Bob's toes, but he's no longer, part of the
Those
family
are
right now. So I would think that the biggest advantage in that scenario is that I think it could be classified as business income rather than passive income, which means the RD2H doesn't come into play. So that the thing that makes passive income in corporations be taxed at 50% off the top, which is a lot of the time, that's one of the concerns that I see clients have, because then there's less money left to reinvest, even though in the long run, you can still plan better, right?
So with RTOs, they're often done, especially with people who are starting out, they're often done, actually, quite frankly, when people are doing volume, RTOs are often done with partnerships. So there's usually some other, co-investor involved in order to do it. And you talked about the fact that, you would typically put partnerships in a corporation. Is there an avenue where you would consider a limited partnership as opposed to a corporation?
I'll be honest, I don't like partnerships. I don't like limited partnerships. My biggest concern with partnerships is that there's very little protection in law for partnerships. So basically a partnership is, people that come together and they have to draft an agreement that will address every single possibility. Whereas if this is done through a corporation, shareholders have inherent protections. It gives them an out in case of a disagreement. There's all kinds of protections in the act itself. Of course, a shareholder agreement is always recommended, because then you can go into the nitty-gritty details of those protections and like scenarios that allow you to dissolve the partnership. But the big issue with partnerships is they're very, very difficult to dissolve when one person wants out and the other person doesn't. And it can take years of litigation to resolve those. So that's my biggest concern with partnerships, although joint ventures may be a way of doing partnerships in a way that's like, it's project specific, however, and that's kind of the one benefit, is that it's easier to look at a joint venture and say, like, what are the outs? When is this ending, right? There's usually an ending to a joint venture. So that could be one way of not incorporating that way. And I see a lot of joint ventures where one person will own the property, but the person who actually has the beneficial ownership of the property, or the corporation who does, is not the same as the individual that holds the company. And then they have a joint venture agreement that they'll register on title. So that is one way that I've seen joint ventures done very effectively.
Okay. Sue, from a mortgage perspective, that's perfect. Thank you, Milena. So from a mortgage perspective, in the same context, when we're doing more active strategies, partners are involved, et cetera, how does that change the mortgaging process?
It changes it definitely when it comes to specifically, the down payment source. So when there's partners coming and there's money coming from different sources, that has to be documented, explained. Not every lender is okay with the silent behind the scenes partner whose name isn't anywhere, but that's where the money is coming from. So that's one thing to take into account. But it depends on the project, what you're doing. If it's a flip, for example, there's lenders that are great for flips and they have no problem with multiple sources of the money coming in from different people. But what I would say about that kind of structure, what I really like is when there is that multi-corporate structure and we have an operating co. And the operating co builds up a history of financials, and we have something more tangible to show the lenders. Like we have this, 2 or 3 year history where the the operating co has generated X revenue. Now we have something that the lenders can look at and say, okay, yeah, there's some business revenue happening. This is not just all rental income, because they're always so nervous about 100% rental income. So it makes our life a lot easier when you have the operating co. It gives us some solid ammunition to go in and show that there's revenue with history.
That's a really good point. I really glad you raised that. Alex, I don't know if you had any other.
Yeah, certainly. So with respect to the first example there, if you're going to build a large portfolio, your exposure changes as opposed to just a small one. So I would definitely recommend that you set it up through the corporation. I've had some issues with some clients in the past. They almost become a target, right? They have a large portfolio, and there are frivolous lawsuits being made, okay, and it really impacts their insurability. So, and it so happened that this particular lawyer was going after them and filing all these frivolous lawsuits. So in that, and again, you're a big fish in a little pond. So I would definitely recommend putting it in in the corporate structure, just to create that additional layer and whatnot. So that's the first answer. With respect to the RTO, in joint ventures, what the joint venture partnership has to understand is and I've only seen this go wrong once. What happens is if there's a claim, the draft or the check is going to be issued in the name of the named insured, right? So the silent partner, if they're not named on the policy, they won't have direct rights to any of the claim settlement. So that, and a lot of people don't understand or realize that. They were never told that with their current insurance broker. So they're now, and again, this goes back to is the JV contract an actual legal document, right? That's a different, that's a whole different scenario, but you are going to be exposed in the settlement of a claim.
Yeah. So you raised a really good point there, and we've seen this just even outside of the named beneficiaries. We've seen it even in terms of tax implications, which I'm sure Bob would be able to comment on, where you have to take a very close look at the JV agreements that are put into place in order to ensure exactly who's holding the liability. And I've seen people get, messed about by, screwed, quite frankly.
Yeah.
Right, in scenarios where they missed one line in a JV document. So there's certainly a piece here with every investor, you want to have your professionals review the documentation that you have in the agreements, but you also need to look at every single line in that document. If you don't understand something, the professionals around here can help make sure that you do understand.
Yeah, exactly. And again, in that one, again, I've only ever seen that go wrong once, Christian. It was that the check or draft was issued for the claim, and the named insured took it, cashed it, and did not give any of the proceeds to his JV partner.
Perfect. So Elizabeth, I don't know if you wanted to add anything else, or whether you wanted me to do sort of the summary, or.
Well, I think I had a quick question for Alex, just purely from a curiosity perspective, and then Andrea had a question too. Alex, so in your experience in insurance right now, what is the biggest source of liability for building owners, and how much are we looking at in terms of an average judgment, so we can figure out how much insurance we should carry?
Yeah, so again, it's as far as with respect to lawsuits, it's the old-fashioned slip and fall. That's where you see the majority of the claims happening are the slip and falls. I think as far as the judgments, I mean, it used to be not too long ago that $1 million underlying liability. It's now $2 million. I'd highly recommend not carrying anything less than that. Some people again want 5 million per policy now, right? So I would say you should be okay I mean, I'm never going to tell anyone. I don't want them to be overinsured, but you don't want them to be underinsured as well. So the answer is 2 million per occurrence, 5 million aggregate is the standard. Some people are comfortable with 5 million per occurrence now, but as far as lawsuits, it would be the slip and fall claims.
Gotcha. Okay, perfect. And then Jessica had a follow-up question just about renter's liability. So I'm assuming, Jessica, you're asking how much liability protection your renters should carry. So $2 million.
Yeah, exactly. And I'll just chime in on that. That is it. I mean, that's a pro tip. Everyone I work with, I highly recommend that they make it mandatory now, and you can make it part of the lease agreement, but previously you could not legally enforce it, but you can now, where you mandate they have to provide you with proof that they have renter's insurance. And what you're doing is you're providing yourself an extra layer of protection. Now, if your tenant, they can't sue their own insurance policy, their own renter's policy, but if anyone else is in that unit and I'll use the slip and fall as the example, what would happen is their renter's insurance, the underlying liability on their renter's policy would be the first payer. If the policy limits are exceeded on that policy, then your policy would kick in afterwards. So it's a great risk management tool to ensure that every tenant. Now, and a common question I get as well is people will say, well, that's fine. They proved that they had the policy, but then they went ahead and canceled it, and I wasn't given any notice. And how you deal with that is you ask to be listed as additional insured on their renter's insurance. All right. It doesn't cost any extra for your tenant, and it just gives you rights and privileges with respect to the renewal of the policy. And if the policy is canceled, then you would be notified accordingly.
Yeah, and that's a pro tip right there.
Yeah, absolutely. Thank you. Christian, do you think we have time to just quickly go to Milena to answer Andrea's question?
Oh, for sure.
Okay. So Andrea had asked, does the 3-tier system need to be set up from the beginning, or can the holdco and the active company be set up afterwards?
So the easy answer to that is it can be set up afterwards. It'll cost a little more because you have to do a rollover. So what Bob had talked about earlier is when you transfer a property into a corporation, you have to roll it into the corporation to avoid the tax consequences. It's the same thing with the shares. So if you start by incorporating one holding corporation that'll just hold the buildings to start, and then you want to prepare the setup later for the other 2 corporations, you'll have to roll the shares of the corporation that you created initially into your new holding company. That will then be the one that you'll funnel money to. So I actually do a little bit of each, and it really depends. I have some clients that want to set it all up at once at the very beginning, but a lot of the time they don't have income in their venture yet. So, you know, the $10,000, $12,000 setup, or it might not be quite that much, but maybe $6,000, $7,000 setup can be pretty costly when there's no income yet. And then you have to maintain those corporations, and you're gonna pay roughly maybe $350 per corporation per year to your lawyer, and then you'll also pay a few $1,000s per corporation to your accountant. Can't really speak to how much it costs for the accountant fees, but that's my experience. So there are yearly fees that it costs, and if it's going to take you 5 years to get to a point where you're rolling, you know, your venture is rolling and making money, it might be worth, you know, spending a few $1,000s more in 5 years to get the proper setup at that point. But at least you've got the income to justify it, and you haven't spent those maintenance costs over the years with a setup that's almost too complex for what your needs are when you first start out. So that's a consideration too, and that is also something that I would discuss with the accountant, at least with the accountant to see if it's worthwhile setting it up at first. So a lot of the times, the more complex setup I will do with clients with very high income, or clients who have multiple properties and they choose to roll them all into a corporation right away. So they already start out with a portfolio.
All right, that's fantastic, and I think that's an interesting piece. I do agree that the accountant has to be part of that discussion, because there may be CRA implications in terms of from a longer term perspective. But at the same time, and colleagues, we're going over it slightly, but I think Sue could probably add a little value here too, in the sense that from a lender's perspective, does it make it easier? Do you have more available lenders if a real estate corporation is at least initially owned by an individual, as opposed to up into a holdco that's then later owned by the individual?
I wouldn't say there's necessarily more options. I mean, once you own the properties in the holdco, regardless of the structure, the multi-tier structure, we're used to seeing it now. As long as we can link everybody together, then it's not challenging. I would say the biggest challenge period is if you have them in your personal name and then you're trying to start the whole corporate structure from there. It's lining up the mortgages when they come up for maturity, because you can't just flip them out of your name midterm.
Right.
So it's lining up multiple different properties that all have different maturity dates, and trying to, it's a nightmare. I've had people go through it, so it's not something fun. But as Milena mentioned, starting off in the holdco as the basic structure and then adding the layers later on is not an issue from a financing perspective.
Perfect. Thank you, Sue. So Elizabeth, shall we do wrap up?
That sounds fantastic.
All righty. Okay. So there was a lot covered in here, right? And I think the simple answer is going to be if you had some some things that you didn't quite get. You know, Elizabeth has been recording this as well, and we will be making this available to all participants on the call here today. So there's, I'm not going to go through all the various details here, but I think the general conclusion that we're coming to is that by default, you should be seriously considering using a corporation as your principal investment vehicle, as opposed to you know, potentially just having it in your personal name and then later on roll it in, or just having it in your personal name. And there's various reasons. We heard, for example, Bob raised the aspect of retained earnings, which is an absolutely critical piece to this, especially as your portfolio grows and it becomes more profitable. You do want to take advantage of the retained earnings. There was the aspects of liability management that Milena brought up and that Alex also brought up. So there are a lot of people who say, oh, you know what, I'm going to build a portfolio of 20 houses and I don't need to be incorporated because I'm just going to carry insurance and everything. So I think Alex was very good at helping to dispel that myth, and Alex is an extremely experienced person with respect to insurance, so you should heed that. That we heard as well that there's a lot of flexibility with respect to estate planning and succession planning. And so often when investors are beginning, they start off with the thought about how do I do my asset protection? How do I do my tax planning? But many of us have to consider the succession planning. So, you know, either you're going to be winding up those assets as part of your retirement plan, slowly selling things off in order to supplement your income, or you plan to pass this on to your heirs, be them your children or nieces and nephews. And so succession planning also has to be considered as part of this, and that's where will structures come in. But it also involves of how, you know, what is your estate plan as you choose to retire and how you're going to transition things in a tax efficient way. So I think those were probably some of the key learnings that we got today. Elizabeth, did you have anything that you wanted to add?
No, not. I think you did a fantastic job of wrapping it up. I think I'm really pleased to be able to say the definitive answer for most of us, you know, in general circumstances, is it's best to incorporate. But I think one of my big takeaways from this is it's so important as you're building your power team and putting your group of experts together to make sure that they can communicate with each other, to make sure that they can have a conversation. And there's been times where I've called my lawyer and I've called my accountant and I've said, this is what's going on. You two need to talk. Let me know what you sort out as the outcome and bring me back in when you're ready to talk. It's, you know, the people that we choose, the level of knowledge that they have, you guys have all been exceptional this evening. And I've definitely learned a lot because I know, you know, you talk to people in bits and pieces and you get fragments of information, but having, you know, the 4 different people represented who are going to help us plan our journey is absolutely fantastic. And I want to thank each of you so much. And I want to thank Christian too. I didn't really fully introduce you, but Christian is one of my absolute favorite guys in Ottawa, and his knowledge and expertise, you can tell he's super detail oriented, and I absolutely love working with you too.
Thanks, Elizabeth.
You're welcome. Oh, and sorry, one last thing. Milena has a takeaway that she's offering to everyone if they would like to send her an email. She has sort of a questionnaire or a cheat sheet to help people decide, you know, what the best course of action is for them from a legal perspective.
Yeah, perfect. And I'm glad you mentioned that you had some takeaways. Elizabeth and I are both quite experienced investors, and we've done a lot of different things over time. And it's a key thing here is that no matter how much you think you know, right, you will always learn something new. And every one of the panelists that we had today brought some new information to every single one of us. So thank you very much, all of you.
For having us.
Pleasure. Thank you.
Thanks, guys. Have a great evening. Hope everyone has a lovely weekend. Thank you so much for coming out. And I'm just thinking how I'll share the recap with you, but it'll definitely be on my Facebook page. And there's an event created, Elizabeth Kelly Consulting, and I'll put the link to the Dropbox there. And then I will see about how the best way is to send it out to everybody who emailed and attended. Thank you so much, everyone. This was an awesome evening. Love spending my Thursday talking about real estate with you guys.